Namaste, good morning. A session to focus on Ind AS and then go for optional tax return. So, the three adjustments which we make after preparing the 115 JB book profit. The three subsections are subsection 2A, 2B, 2C, which will be for Ind AS adjustments. Subsection 2A is the other comprehensive income part of it. Amount credited will be added, amount debited will be reduced, items that will not be reclassified, items that will not be reclassified into P&L. The terminology that gets importance is that will not be. Okay, and nowhere revaluation is a concept, so tangible, intangible and fair valuation of equity investments will not be taken into consideration. Then effect of revaluation due to demerger, and then 1/5 of transition reserve. Transition reserve is the reserve that arise due to adopting Ind AS for the first time. In the preceding year, it is being done. So it is allowed in five ways, or it is adjusted in five equal installment over 5 years. Credit means add, debit means less. Transition reserve not to include securities premium, capital reserve, revaluation reserve, and forex reserve. Uh, you'll see now. I'm in question number 10. Alpha and Beta Tires Limited, an Indian company engaged in the manufacture of tires in Andhra Pradesh, has adopted Ind AS from the preceding year. The following particulars are provided. Net profit as per profit and loss account 20 crores after debit or credit of the following. Items debited, depreciation which includes 3 crores being revaluation. Interest charged in delay in remittance of TDS. Items credited, share income from associate of AOP in which the company is a member. Amount of 6 crore withdrawn from reserve on account of revaluation. Other information, the application of the financial creditor for a corporate insolvency resolution has been admitted by the Hyderabad branch of the Company Law Tribunal. Okay, under IBC. Brought forward business losses and depreciation for 1718, 1819. Items credited to other comprehensive income which will not be reclassified, remeasurement of defined employment benefit, revaluation surplus of property, plant and equipment.
நம்ம இடத்துல வச்சுக்கணும்
Transfer,
எல்லாத்தையும்
can you,
எவனையும் நம்பி கொடுக்கூடாது.
somebody's mic is on, can you please mute it? Can you please mute the mic? The transition amount as on convergence date stood at 5 crores, including capital reserve of 50 lakhs. Tax payable under regular provisions comes to 63 lakhs. Compute the MAT payable by the company. Compute the amount of MAT credit, if any, eligible to. Read through. Can you take it? No. Computation of book profits under section 115 JB. Depreciation 18 crores. Depreciation 18 crores. Interest charged due to delay in remittance of TDS. Okay, I told you this is allowed. This is not an interest of your income tax, of the company's income tax. This is an interest paid for some other person's income tax. We said in TDS chapter we will deal more about this. So this is allowed. Please understand, this is allowed. There is no disallowance. Okay. We will deal with it when we do TDS provisions. As of now, please understand there is no disallowance for this. There is no disallowance for this. Are you so far clear? Are you so far clear? Okay. Now, please understand, since the company's application for insolvency is pending in NCLT. Since the company's application is pending in NCLT, what happens? Both, yeah, both brought forward loss and unabsorbed depreciation will be reduced. It is and not or. It is and not or. Pull up the chat. You can pull the chat. Okay. So what happens? 3 plus 1, 4, uh, plus 5, 9, 11 crores. 8 plus 2 plus 1, 11 crores. This point is known as book profit under section 115JB subsection 2 before making Ind AS adjustments. Before making Ind AS adjustments. Now I'm going for Ind AS adjustments. Okay. Items credited to other comprehensive income. Items credited. So I need to add. Okay. I need to add items credited to other comprehensive income which will not be reclassified to P&L. Which will not be reclassified to P&L. Okay. Remeasurement. So add items credited to OCI which will not be reclassified to P&L. Remeasurement of defined employee retirement plan. Remeasurement of defined employee retirement plan. 5 crores. Revaluation surplus not to be considered. Any revaluation under 16, Ind AS 16 for tangible assets, 38 intangible assets, and 109 financial instruments should not be considered. So this revaluation surplus should not be considered. Should not be considered. 50 lakhs, sorry. Okay, 50 lakhs. Okay, right. Next. Transition reserve on the convergence date stood at 5 crores including capital reserve of 50 lakhs and it is credit balance. So capital reserve will not be taken. Remaining 1/5 should be added. Credit balance should be added. It should be 1/4/2019. The convergence date is 2019. uh, Original question is 16, so as it is I copy, so it should be 19. Please change this to 19. Please change this to 19. 1/5 of transition reserve, since it's credit balance. 1/5 of transition reserve. Okay, what is the transition reserve? The transition reserve is 5 crores less capital reserve is 50 lakhs. Net transition reserve 1/5 of it. So this will be 4 crore 50 lakhs. This is 1/5 of it. Why are we? We are not considering, we have taken it off. Huh. Yeah. No, no, that's why. Suppose, let me take an example. 5 crores is the machinery value today. You have revalued upward by 1 crore. Okay. So what happens is this revaluation might be apportioned to the profit and loss account over a period of time. The accounting standard 16 9 okay, the accounting standard says that the revaluation can be apportioned to the P&L. Okay, so when you apportion that, that also will be disallowed. If it is debited, it will be added back. If it is credited as income on revaluation, it will be taken out. That goes by the fundamental concept only. Why we are not, revaluation is never a concept. See, revaluation surplus kudutonna, what happens? Whenever you charge depreciation, you need to now give it along with devaluation. Normal tax is 63 lakhs. Okay, assessee is liable to pay tax as per MAT or normal provisions, whichever is higher. So he will be paying this MAT credit to be carried forward. Difference between MAT and normal tax. This can be set off against the normal tax payable within the next 15 AYs. Are we clear? Then next is also an examination question. Zenith Formulations, an Indian company engaged in pharmaceutical formulations in Tamil Nadu, started adoption in the AS with effect from 1st April. The following particulars are furnished. Book profit after adjustment of all items except brought forward losses 52.26 lakhs. Brought forward losses as per books is as under. The business loss has been deducted while computing 115 JB. This is the question came as it is, but you should allow both these things. You should allow both these things. The question came as it is. I thought it is already adjusted, but when I saw the suggested answers, they have again reduced it, saying the only assumption I can think is in those years they would have paid normal tax, so it remains to be unadjusted. So when they give the brought forward loss and unabsorbed depreciation, please reduce it. Please reduce it. The particulars of other comprehensive income for the year ended. OCI that may be reclassified should be ignored. That may be reclassified should be ignored. Okay, while computing book profit. OCI that will not be reclassified. That will not be reclassified to P&L. Changes in fair value of equity. Deferred gain, which should not be taken because it is 109. Deferred cash flow hedges, deferred cost of hedging, share of other comprehensive income of other associates, remuneration of post-employment benefit, revaluation surplus of assets should not be taken. Transition amount on the convergence date is 42.5 credit balance, including capital reserve and forex reserve. The NCLT Chennai bench has admitted the application for insolvency made by the creditor. So that's why I said it needs to be reduced. Compute MAT liability applying the provision, assuming that the income tax under normal provision comes to 9.2, compute tax credit if any, and the carry forward, including the period up to which it can be carried forward. Go ahead, please. 5226 brought forward losses and unabsorbed depreciation, book profits that will not be reclassified, deferred gain, share of other associates, remeasurement of employment benefit, deferred cash hedging is a debit item which needs to be reduced, one fifth of transition reserve. So I get 5761. Hmm? Okay, okay. Any doubts? Question number 12. Maitri Jeans Private Limited is in the business of manufacturing jeans. For the AY, it has paid 15% on book profits computed under 115 JB. The AO, though satisfied that it is liable to book profit, want to charge 234 B and C as advance tax was not paid during the financial year. Company seeks your opinion. Is the company liable to pay? Yes. Why? All other
Other
provisions.
provisions applied.
Yes.
I was just saying that, sir. All other provisions of income
All other
tax shall apply.
provisions are applicable. Rolta India Limited case law. ROLT. Rolta India Limited case law. In Rolta India Limited case, it is held by the Supreme Court that all other provisions will apply in the case of book profits computed as per section 115 JB. Okay, this is section 115 JB subsection 5. That is where it is said. Hence, advance tax, and where advance tax is not paid, interest under 234A and 234B and 234C shall become payable by the assessor. question number 12A is for you to get tested with 115 JAA. How to adjust that? Okay. Year 1819, income as per normal provision, income as per MAT, taxable at normal rates of 25% plus HEC 4%. So it will come to 26%. Similarly, 15% plus 4%. Tax payable, tax credit utilized, and tax credit carry forward. 1819, 1920, 2021, and 2122. Compute tax for every year, please. Compute tax for every year. We should understand some important aspect. Our friends here have said that so 26% and 15.6 is the effective rate adding. So normal tax for 1819 comes to 1040. Book profit and MAT comes to 1279 200. MAT payable and a tax credit to be carried forward 2,39,200 for the first year. 2,39,200. For the second year also, MAT is payable 1404. So the tax credit to be carried forward 4,73,200. Totally 234 of the current year and 239,200 of financial year 1819 to be carried forward. Shall we? Shall we? In the financial year 2021. This is the year where our friends here have been. MAT means minimum alternative tax. That has to be paid. By availing the full credit, if my normal tax comes below MAT, MAT is payable or the credit cannot be fully utilized. In this case, 50 lakhs is the income on which you are getting a tax of 13 lakhs. MAT 1092. So no doubt in the year in which normal tax payable, you can set off the MAT credit. Okay. However, by utilizing the MAT credit, had I utilized the full 4,73,200, had I utilized the full 4,73,200, my normal tax comes to 8,26,800, but MAT is 10,92,000. So again, MAT becomes payable. MAT means minimum alternate. You should pay that tax. Minimum tax you should pay. So I cannot utilize the entire 473,200. I can use it only up to 2,08,000. Okay. In the year in which normal tax becomes payable, MAT credit can be brought forward and adjusted. However, if by utilizing the net tax is below MAT, then full utilization is not possible. Hence, only to the extent of difference you can utilize. Any doubts? Any doubts? Okay. So net tax payable 11 lakh 64,800. That's what we are getting. So MAT credit utilization is important to understand. By utilizing the MAT credit, you cannot pay lesser than what that year's MAT is. So MAT itself is minimum alternative tax, and that needs to be paid. That needs to be paid. Am I clear to you? Right? Okay. We go into the next arena. MAT questions will be very simple. If there is a question on MAT, it is a straightforward question. There will not be any twist and turns. It will be straightforward. Miss not to answer that question. Miss not to answer. Okay. So MAT will be really a simple question. Whatever has been appearing in the last few exams, we have done it. Okay. Moving forward to optional tax regime. Okay, or alternative tax regime, right? Internationally, one thing is famous. Why to make the law so complicated? Make the law simple in such a manner that somebody can directly go to a counter and pay tax. Okay, why to put so much of conditions, so many things? Keep the rate moderate and pay the tax. Otherwise, if people want to avail exemptions and deductions, then keep the rate high. So came the concept called alternative optional tax regime. We first introduced it for companies in the financial year 18, then moved on to introduce it even for, the financial year 19, and then moved on to introduce for individuals also from financial year 20. The cooperative societies are also covered. 115 BAA, 115 BAB is for companies. 115 BAC is for individuals. 115 BAD is for cooperative societies, and it's a self-confession by the department by naming it as 115 BAD. Okay, right? Okay, because cooperative society got a benefit, they are getting better benefit under ATP. I'll tell you when we come to that. So comes this provision called MAT. Okay, optional tax regime. Okay, assessee should be ready to forego some additional deductions which are provided, should be ready to forego deductions, and I assure him MAT is not applicable for him. If these are satisfied, then it is applicable. Yet to get very popular, but slowly companies are trading companies, such companies, it will be viable for them to go to this regime. So this is the book pro. Let's understand optional tax regime. This is applicable only if assessee foregoes the following benefit. Assessee should not avail the following benefit. What are all they? Exemption under section 10AA you cannot avail. You should not avail the exemption under 10AA. Other exemptions you can avail. Okay. You cannot avail additional depreciation, the 20% which is available only for manufacturing entities, or 10 in the first year, 10 in the second year, where it is used for lesser, that also you cannot avail. You should not avail 33AB and ABA, that is 40% of profits, 40 or amount deposited, whichever is less. In the case of ABA, 20%. You should not get 35 AD. You should not get scientific research expenditure, agricultural extension program and skill development program. And you should not avail any deductions under chapter 6A except 80 JJAA for promotion of employment and 80M for dividend, intercorporate dividends. Repeating, what are all the things assessee cannot avail? That is the key factor. Okay. What are all the things assessee cannot avail? In terms of exemption, 10AA assessee cannot be availed. Under PGBP chapter, what assessee cannot avail is additional depreciation, scientific research expenditure, 35 AD, and agricultural extension or skill development. So all section 35, what is the sanctity of 35? 35 where the capital expenditure itself can be claimed as deduction. That is the sanctity of 35. So that cannot be availed. Wherever capital expenditure is allowed, that cannot be availed. In terms of chapter 6A deduction, you cannot, what is available for a company? 80G is available, 80GGB is available, 80I is available. Okay, so deduction under chapter 6A cannot be claimed. However, I am maintaining two things. Promotion of employment you can still claim, and 80M you can still claim. Am I clear to you? Okay, quickly in our notebooks, please. Quickly in our notebook. Optional tax regime hyphen section 115 BAA and BAB. Optional tax regime section 115 BAA in our notebooks. Section 115 BAA and 115 BAB. The following are not eligible to be claimed. The following are not eligible to be claimed. Once right, it will be useful. Under that, exemption is the title. Under that, section 10AA. Exemption is the title. Under that, section 10AA. Please remember, other exemptions can be claimed. I am not going to tax agricultural income. I am not going to tax share of profit. Okay, those exemptions can be claimed. You cannot claim 10AA. Next, PGBP. Under that, additional depreciation. Okay. Deposit section 33, deposit based deduction hyphen plantation sector, deposit based deduction hyphen for whom that is plantation sector and oil natural gas. Plantation, if you remember tea, coffee, rubber, 40% of profits or amount deposited within 6 months in NABARD or any specified bank will be allowed as deduction. Okay, that you cannot claim. Okay, because you can understand it is an asset. Deposit vandu or asset. In your balance sheet, if I deposit, I will show it in balance sheet asset side and I will not show it as an expenditure. But to promote I was giving, I am asking you to forego. Okay, next. Or oil and natural gas. Other than 33 ABA, anga vandu 20%, not a popular section that is. Next. All sections under 35 where capital expenditure can be claimed. all sections under 35 where capital expenditure can be claimed. For easy of remembrance, hyphen, specified business, comma, scientific research, comma, agricultural extension program, and skill development. Comma, scientific research, comma, agricultural extension program, and skill development. Okay, okay, right? People, slow. This you cannot claim. There is nothing in capital gain, IFOS. Okay, there is nothing in clubbing. Now the heading is set off. Now the heading is set off. Okay, please understand, laws can be brought forward and set off, no doubt about it. Okay, all of us, please understand, laws can be brought forward and set off. But if the loss is due to these things, if the loss is due to these things, it cannot be brought forward and set off. To that extent, to that extent. Okay, friends, I have an unabsorbed depreciation brought forward. We have unabsorbed depreciation brought forward, and this is due to last year I charged additional depreciation. Because of that, I have an unabsorbed depreciation. Or unabsorbed capital expenditure on scientific research, unabsorbed capital expenditure on agricultural program. So these losses cannot. Okay, if the question is, can loss be set off? Yes, I never say loss cannot be set off. Please understand, business loss can be set off. However, loss arising to any of the items mentioned above. Okay, loss arising to, okay, brought forward unabsorbed depreciation due to additional depreciation cannot be claimed. Okay, I'm not saying completely you are losing any of these things. In this additional depreciation level, loss is possible. Others are very rare. So under that set off, under that, loss arising due to additional depreciation or any capital expenditure mentioned above, loss arising due to additional depreciation or any capital expenditure mentioned above, cannot be brought forward and set off. Cannot be brought forward and set off. Otherwise, business loss can be set off. I'm coming to it. Matt done, companies done. I'm coming to that.
So otherwise, normal depreciation unabsorbed can also be claimed.
You can set off. The unabsorbed depreciation due to normal depreciation, you can set off. Only if it is due to additional depreciation, you cannot brought forward and set off.
Okay, sir.
Can be carried forward and set off. Next heading, deductions under chapter 6A. deductions under Chapter 6A cannot be claimed except 80JJAA and 80M. Cannot be claimed except 80JJAA and 80M. MAT credit cannot be claimed. MAT credit cannot be claimed. Okay, okay. We will continue with the theory, but first we will now understand. There are two sections, my dear friends. 115BAA, 115BAB. Why two sections? 115BAA is for an existing company. 115BAB is for a new manufacturing company. Why two sections? Two sections is because one section is for an existing company which can also be a manufacturing company. 115BAB should only be for a new manufacturing company. Okay? Why new man? Because in the second term of this present government, the first thing they said is we should get indigenous manufacturing facility for majority of the things. Okay, so to make that dream possible, the manufacturing companies are given a concessional rate of tax. Let us go slow. Applicability. Any domestic company, you need not write it. First letter. Manufacturing companies, including those engaged in generation of power. In additional depreciation itself, I have told you, generation of power is also a manufacturing activity. Who can avail any domain? Only a new company incorporated on or after 1st October 2019. That is the date of this provision. That is the date of this provision. Why you will wonder why 1st October 2019 is the date of its provision? Because that was the year of election, new government formed, and they presented the budget only in August. That's why 1st October 2019. Rates of taxation. If you forego all those things, the rate of taxation is 22% base rate. It is in the case of any company. 10% surcharge, mandatory surcharge right from rupee 1. 4% HEC, 25.168%. Whereas, sorry, gross mistake this is. This is 15%, please. This is 15%, please. 15% plus 10% plus 4%, 17.16%. 17.16%. Am I clear to you? So, in the case of existing companies, even it can be a manufacturing company, the rate is 25.168. For a new manufacturing company, the rate can be 17.16%. Okay, let's go slow and understand things. Okay. Okay. So, rate of tax for new manufacturing company. Okay, the rate is 17.16%. Okay, right? Okay, I'm taking this because of some other reason. This is only for business income. 17.16% is only for business income. Suppose the company has IFOS, IHP, okay, some other incomes. Then this concession of 17.16 I am not providing. These are taxable at 25.168%. These are taxable at, okay, 25.168%. Okay, these are taxable at 25.168. Okay, 25.168%. Okay, I hope it gets okay, somewhere around 25. Okay, so please understand, where the income is not a business income but any other income, it is taxable at 25.168. Income other than business income, same, inga 25.68, inga it will also be 25.168. Okay, are we clear? Then does this mean that STCG on which STT is paid, LTCG on which STT is paid, okay, general LTCG, all these things are taxable at 25.168%? No,
No,
special
sir.
rates remains as it is. This is taxable at 15% only. This is taxable at 10%, okay, of LTCG exceeding 1 lakh, and this is taxable at 20%. And winnings obviously is taxable at 30%. So special rates are going to be the same. Special rate, income which are taxable at special rate, that rate plus 10% surcharge plus 4% HEC. So the manufacturing companies getting a concessional, new manufacturing companies getting a concessional rate of tax is only for their business income. Any other income, still it is a concessional rate, 25.168. I understand your question. The question from her is, if I do manufacturing as well as another activity, law is silent, so I will take 17.16. Business income 17.16. Yeah, yeah. Split the unabsorbed depreciation into two. Unabsorbed depreciation due to additional depreciation, unabsorbed depreciation due to normal depreciation, and claim it. All these things in category 1. Category 2, it's a new company. Okay, right. 10% fixed, there is no income limit. Will remain. That is dividend from specified foreign company. Yeah, it will remain. All special rates the same. I understand. Dividend from specified foreign company will continue to be 15%. Whatever is the income which are taxable at special rates, that rate plus 10% surcharge plus 4% HEC. Are you so far clear? Right. Inter-unit transfer. We all know if I am carrying on two different businesses, manufacturing business or two different taxes, manufacturing business is taxable at a lesser rate and the other business might be taxable at a more rate. So to show manufacture, I transfer it at a higher price. No, not possible. Inter-unit transfer of goods only at fair market value. Even if I am buying from a company, I cannot buy at a very less price and show a high profit. We have seen in 80 IA1 question, cement division, infrastructure division. 20 lakhs worth of cement is transferred from cement division to infrastructure for that value. Whereas if I have sold outside, I would have fetched 25 lakhs. So what we did, 5 lakhs we added to the cement division profit. So inter-unit transfer only at market value. Suppose it is not at market value. Please understand this. Suppose it is not at market value and the assessing officer finds that. For that amount, this concessional tax regime will not work. Whatever assessing officer is, this is not only here. This is part of domestic transfer pricing. All through transfer pricing, that is the provision. Where assessing officer increases the income, you will not get benefit. So, inter-unit transfer not at FMV, adjustment made by applying domestic transfer pricing provision. Income adjusted by AO is taxable at 30% base rate. You will not get that concession. Even if the company's normal rate is 25% only, but still this is taxable at 30%. Brought forward unabsorbed depreciation cannot be claimed. Here it is not applicable. This is a new company. MAT credit cannot be claimed. Here, in any year, you can exercise the option. Adjust all those credits and then come to this option. Whereas here, before filing your first return of income, say whether you are going to go by 115 BAB or not. Okay? You cannot withdraw once the option is exercised. It is not like other schemes where you can withdraw 5 years, you cannot withdraw. Ananya?
Yes, sir.
Do you remember that I asked you what is an explanation? I mean, we have discussed in the class what is meant by new business. Do you remember?
Yes, sir.
What is that? Two conditions?
It should not have been formed by splitting any other business.
Demerger. It should not be demerger.
And I think some percentage of the plant and machinery should be new.
80% of plant and machinery should be new. So the same explanation holds good. Should not be formed by splitting up of an existing undertaking. Should use new plant and machinery. 20% can be old. Second-hand machinery on which depreciation is not claimed under income tax law will be treated as new machinery. Okay? Okay? I want you to read through once. I want you to read through once the entire provision. the doubt that our friend has is about the new manufacturing company, why it will not get unabsorbed depreciation or additional. See, new manufacturing company has only one option. In the first year itself, you have to opt for this scheme or never. If you have opted for this scheme, you will not have claimed additional depreciation. Where is the question of unabsorbed? New manufacturing companies, okay, the law says the option has to be exercised in the first year itself, not even before filing their first return. 2019-20 they have formed after 1st October 2019. That year itself they have to opt. And the year opt panla. In the current year, they don't have the option of 115 BAA itself. They can go for 115 BAB. That's all. I'm sorry. There's no option for 115 BAB. They can go for 115 BAA. New manufacturing companies, companies which have commenced the operation in the first year. If this is the first year, 21-22 is the first year, then before 31st October 22, they have to decide whether they are going to opt for 115 BAB or not. Suppose a company is formed in 2021, new manufacturing company. They did not opt for 115 BAB. In 21-22, they don't have the option. Before filing their first return, they should have. The only option they have is go for 115 BAA, existing company 115 BAA. This is one thing. Again, I want to speak about the rates of taxation. 115 BAA easy rate, only singular rate, 25.168%. 115 BAB multiple rates, 3 rates. I'm not talking about special rates, 3 other rates. For business income, 17.16%. For any other income, 25.168%. For income which is increased by the assessing officer, because you have not followed the unit transfer on fair market value, 30 plus 10 plus 4%. Otherwise, special rates are common. Forego the benefits. சொல்லுங்க friend, you're clear? Unabsorbed depreciation due to additional depreciation only cannot be claimed. Unabsorbed depreciation due to normal thing can be claimed. Okay. Okay. Understand this concept also. Existing manufacturing company. All of us has to understand this. Existing manufacturing company. Okay. For the first time in 21-22, they opt for, okay, alternative regime. So they will be coming under 115 BAA. Existing company, 115 BA, not a new company. In the financial year 2021, they had purchased a mission in November 20 for 40 lakhs. What would have happened? 10% additional depreciation would have been claimed in 2021. 10% additional depreciation they would have claimed in 2021, thinking balance 10% they can claim in 21-22. Balance 10% they can claim in 21-22, but in 21-22 they opt for alternative regime. So no additional depreciation. This 10%, please remember, please understand, I have already claimed the 10%. The balance 10% I am supposed to claim this year, but I cannot claim because I have got for additional tax rate. One benefit the law gives me is, okay, reversal கிடையாது. That year it's over. Increase the opening WDV for the unclaimed amount. For example, opening WDV is, let us take 83 lakhs. Last year's closing WDV, current year's opening. And additional depreciation unclaimed. Okay, 4 lakhs. That is 40 lakhs into 10%. 40 lakhs into 10%. Therefore, revised opening WDV is 83 plus 4, 87 lakhs. Therefore, a revised opening WDV 87. On this you can check. This is the only benefit available. Unclaimed additional depreciation, you can increase it. Increase it now. Last year claim 10%, you are adding back. It's equal to that. Last year, whatever you have claimed, as if I will take that you have not claimed and adding back to the block value. Adding back to the block value. Okay. புரியல. In PGBP, I said that you will understand one thing later. Okay, that's where I'm going to. Okay.
Exception to something, sir.
Very good, very good. You are right. Okay. Explanatory note. Opening WDV is nothing but the previous year's closing WDV. There is an exception to this rule. We shall understand it in optional tax section. Normally, opening WDV is last year's closing WDV. But when it will change, when there is an portion of unabsorbed, unclaimed depreciation. What do you mean by portion of unclaimed depreciation? I promised 20% additional depreciation. Interpretation of law. First year I am only claiming 10%. The balance 10% can be claimed in the subsequent year, but I am unable to claim because I have gone for optional tax regime. Whatever I have claimed already, you can add it up. The law எப்படி சொல்றாங்கன்னா, the unclaimed portion, which will also be the same amount, can be added up to the opening value. Yes. The provisions will apply to the transferee company. Asset value will not change.
Sir, so
So,
in essence, can you just confirm if I've understood this? The law says that even since you didn't get the 10% which you should have ideally got because you opted for optional tax regime, I will give you a percentage of the depreciation that you missed out on.
yeah, whatever you have missed out on, you can claim it on a pro rata basis over a period of years. You can understand like that.
Okay, yes, sir.
Actually, I understand I missed out that point in the writing in the material, but I will ensure that in 115 BAC I am writing that point. Okay, if you look at this is the law, this is our study material. This is our study material. The point which I missed out. Okay, I'm trying to hold you back on that point. These are all the deductions you cannot claim, etc. The third point, where there is a depreciation allowance in respect of a block of assets from an earlier year attributable to additional depreciation, which has not been given full effect to, which means only partially it's claimed, and which is not allowed to be set off due to now you going for 115 BAA from that year, corresponding adjustment shall be made to the opening WDV. That is, the opening WDV will be increased by the unabsorbed additional depreciation not allowed in the current year. That is what it is. You should have claimed 20%. You have claimed only 10%. Now you have opted for 115 BAA. You cannot claim that 10% at the opening WDV accordingly. This is tax planning. Since there is no time limit, I will always look for a better. Ananya's doubt was why I am giving that benefit is in the future years I can claim that amount as normal depreciation. I said yes. Question number 14. Question number 14. The following are the particulars relating to two Indian companies, Alpha and Beta, which are subjected to tax audit. Date of establishing, Alpha is an existing company, Beta is a new company. Alpha is an existing company, Beta is a new company. Alpha manufacture of steel, Beta manufacture of leather. Turnover of 1920, 2021 and 21-22. We are only concerned about 1920 because that percentage of tax is 25%. Don't take 2021 turnover. Okay. Value of plant and machinery installed and put to use on 1/11/21, 8 crores, 5 crores. Gross total income for financial year 5 crores, 3 crores. Number of employees employed on the date of setting up or registration 750, 750. Monthly emolument paid through approved modes 250 employees 20,000, 21,000 allowed. Another 250, 25, 25 allowed. The remaining 250 not allowed because it exceeds 25. Compute the tax liability of Alpha and Beta, assuming that they avail the beneficial tax rate under the special provision inserted by the tax law by fulfilling the conditions thereon. Assume that gross total income reflects the computation under the special provision. would it be beneficial for Alpha to opt for the special provision inserted by the taxation amendment law instead of opting for the regular provision? Alpha matram. Beta ka obviously 17 is a very small rate, 25. That is why they are asking. Read through. I'll write some notes before commencing. I'll write some notes before commencing. Okay. Leather manufacturing is a okay seasonal industry. Hence, for 80 JJAA, 150 days instead of 240 days will be considered. In the volume 2, I'll give you what are all seasonal industry. Okay, but normally they give you, okay, that it is a seasonal industry. Leather manufacturing is a seasonal sector. So the 150 days instead of 240 days will be considered. Okay. I am first going to do for alpha. I'm first going to do for alpha. Let's do two column. Normal tax regime, optional tax regime. Computation of income of Alpha Limited existing company. The question says compute the time assuming that the levy has been inserted by the fulfilling condition. Assume GTI reflects the computation under special provision. So gross total income without providing additional depreciation. Gross total income without, they have said that it is as per the special provision. So gross total income without providing additional depreciation 5 crores. Less additional depreciation. %, on new plant and machinery which is used for a period of less than 180 days. So we all know that the new plant and machinery is 8 crores. 8 crores. This you can claim only in the normal tax regime. In the optional tax regime, additional depreciation is not available. $250 employees into 20,000 into 12 plus another 250 employees into 25,000 into 12, the whole into 30%. Here I am writing detail 250 into 20,000 into 12, 250 into 25,000 into 12. Okay, these two things, okay, into 30%. Yeah, 1 minute, Hari. They are direct. There, I don't want you to do normal, normal return. It is only optional tax return. Yeah, go ahead, Hari.
இந்த depreciation additional கொடுக்காதனால இந்த 115 BA இல்ல, we have to calculate that depreciation also, no?
Once more, Hari.
The additional depreciation we are not allowing in 115 BA. Hello?
We are not allowing additional depreciation.
Yeah, sir. That is what, no, we have to add it in the opening block and allow the depreciation.
It is additional depreciation of the current year, not the past years, to add it to the opening balance.
Okay. Yeah.
Sir, don't we have to do MAT for normal and then check the tax amount?
There is no adjustments like the 20 adjustments of MAT le edume illiye, Ananya.
Yes, sir. If it is there, we should do, no, sir.
100%.
Okay, sir.
Only the optional tax regime for Beta Limited. $250 employees into 21,000 into how many months? November dana? November 1st dana setup? 111. November,
Yes.
December, Jan, Feb, March. 5 months. Parka? Is it clear? A newly established manufacturing company commences the operation, provides you the following and seek your detail on the taxation following all specification, advise comprehensively. Net profit before claiming the following: contribution to National Lab for Research, in-house research expenditure, plant and machinery used in November for the purchased in November used for manufacturing, deduction of eligibility under 80IA. Apart from the above information, the company is also owning a house property which is let out on a monthly rent of 120. The above income is not credited to P&L, hence not included in the net profit. Interest earned on surplus fund invested, which is also not included in the P&L, 3,11,000. Please change it to November 21. Please change it to November 21. Now it is tax planning. Which is better? Which option is better? Okay, whether to go for normal or to go for optional tax regime. Like Alpha Limited, we'll do it in column. Try to do it. Don't look into the answers. Try to do it on your own. house property will have standard deduction of 30%. Remember that. Always this is a flat deduction. Yeah. Now understand how to compute under normal system 25% of total income. So this into 25%. Sunda? Under normal 25% of total income. Under alternative regime, 15% of business income. 15% of business income into 15%, 22% on HP and other sources income. Okay, okay. 22% on house property and other sources income, 4 lakh 20 plus 3 lakh 11,000 into 22%. So base tax and surcharge 7% under normal regime as income exceeds 1 crore. %10 under optional regime irrespective of level of income. So optional regime is more beneficial. மேட்டுன்றது எப்ப வரும் அப்படின்னு நான் உங்களுக்கு சொல்றேன் கேளுங்களேன். புக்ல இருக்கிற 15 அட்ஜஸ்ட்மெண்ட்ஸ், ஓகே, provision for taxation, proposed dividend, அதெல்லாம் டெபிட் பண்ணியிருந்தாலும், எக்ஸம்ஷன்ஸ் எதா இருந்தாலும், இந்த கேஸ்ல டிப்ரிசியேஷன்ன்றது புக்ஸ்ல நமக்கு தெரியும். Unless they give you those adjustments, don't do that.
Sir, I have a doubt actually.
Go ahead.
Suppose if we had some deductions under Chapter 6A for optional tax regime, can I adjust the deduction against other income so that it will be tax beneficial for?
No, none of the deductions can be claimed if you are
No,
going
sir.
for optional tax regime.
That 80JJ and
Nothing can
80.
be claimed.
Oh, sorry.
80JJ can be claimed. You can even adjust it against your other income if you don't have business income. If that is your question, yes, you can do
Yes,
that.
sir.
Yeah,
Okay.
yes, you can do that. An existing company compute the income and taxable, also work out the optional net profit after debiting or crediting the following: depreciation, profit on sale of machinery, interest income, dividend income from domestic company, STCG on sale of listed shares, STCG on sale of listed shares, spouse of director is employed in an organization, salary 72,000 per month. On analysis, you feel that the similar employee salary is 60,000. Payment of expenses by cross the check. Donation to recognized political party, employer and employee. Contribution of 185 towards PF for the month of March was paid in September. Employee contribution is included in salary and employer contribution in staff welfare. Interest payable as on 31st March 190, 50% is only paid. Contribution to a company whose main object is research is 1 lakh. Other detail, plant and machinery opening WDV, additions to plant and machinery used for manufacturing process in July, December, other assets depreciation, brought forward losses, business loss, unabsorbed depreciation only due to additional depreciation of the last year, unabsorbed scientific research expenditure, okay, now 1920. Read the question. First, let us compute the total income. First, in the normal manner, let us compute the total income. Okay.
Sir, actually, in the previous question, my doubt was if it was both business income and we had also income from other sources. Can I adjust that chapter 6A deductions under with income from other sources so that it will be tax
I got your
beneficial for me?
point. Yeah, I am clarifying that point. Your question is, I have business income as well as IFOS. I have a 80 JJAA. Can I adjust it first against the IFOS so that business income is taxable only 17.16? No is my answer. If you have a 80 JJAA, only from business income first you can set off. Balance, if any, can be set off against IFOS, but not directly, only with IFOS, so that my business income is taxable at a lesser rate.
Okay, sir, thank you.
Majority of the question is from PGBP. No. Depreciation working model protocol. Okay, I will do it last. Okay, I will do it last. Depreciation. Please change it by 1 year. December 20, November 21, like that. Please change it by 1 year. I think I raised a wrong file. That's what it is. Okay. Okay. Now, employer contribution to PF paid within due date of filing returns, hence no disallowance. Employer contribution, you have till 30th September or whatever it is, you don't have a disallowance. Employees contribution to PF, this
Due
should
date is
have
as per
been
the specific act.
uh,
The due date is as per the specific
within the due date of the specific statute. Okay, the specific statute where it is not paid within that date, where it is not paid within that date,
it is disallowed.
is that the right word?
Treated as business income. Sir.
Yeah, it will be treated as income. Section 2, subsection 24. 36 has been amended from our year. Okay. Law itself has been amended. So the employee's contribution, 1 lakh for month of, okay, employer and employee contribution of 185 towards the month for PF. Okay. So 185 each நினைக்கிறேன். Okay. Can you somewhere put each employee and employee contribution of 1,85,000 each? Please put each.
Sir, the interest payable to State Bank for machine purchased, if okay, sir, I got confused. I thought it
It
was
is
for the
not
new
big
machine.
borrowable cost to be capitalized unless the word it is before put to use appears.
Okay, sir. And also the machine was purchased in December 20. So which is mentioned. Okay, sir. No, got it.
I am doing it here itself, please don't mind. Allowable depreciation. Plant and machinery. Okay. First I am doing normal. First I am doing normal. I am doing here itself. You should actually technically do a working note, but since I started, I am doing here itself. Please understand, 52,10,000 plus 17,10,000 minus what is the sale value of the machine? What is the sale value of the machine? Profit on sale of machine. Book value is 3,55,000. 3,55,000 into 15% plus 8,40,000 into 7.5%. I hope the class is clear. Opening WDV plus additions more than 180 days minus deletions. Deletions, I got it in my P&L account. Book value is 310, sold at a profit of 45,000. So the sale value becomes 3,55,000. $52,10,000 plus 17,10,000 minus 3,55,000 into 15% plus 8,40,000 into 7.5%. I should not have put commas here. Is it correct? Yeah. Plant and machinery additional 17,10,000 into 20% plus 8,40,000 into 10%. 17,10,000 into 20% plus 8,40,000 into 10%. Is it 426? Okay. Other assets, they themselves has given. Other assets, they themselves have given 280. Business income. Can you check and let me know, is this right? Is this right? As it is continuing, capital gains. STCG on which STT is paid, STCG on which STT is paid, 3 lakhs. No, actually I should have adjusted the business losses first. Less brought forward losses. Business loss 210. unabsorbed depreciation 62,000. Unabsorbed capital expenditure on scientific research 50,000. Scroll up. Capital gains STCG on which STT is paid 3 lakhs. Other sources interest income 75,000. Dividend 3,45,000. Gross total income. Deduction under section 80 GGB political contribution. How much is that? 2 lakhs. Depreciation, profits, pounds, employer interest payable contribution. Is this clear? Any doubt? It's more of a PGBP question. Okay. Okay. Now, using this total income, let us find out what will be the total income under optional tax return. What are all allowed which will not be allowed. If I add it back, I will get the total income of, we need not work out from the top. One thing we have to remember, optional tax regime also has all the PGBP provisions. Only some things are not allowed. Okay. Some next step is total income under optional tax regime. And deduction under 80 GGB, which cannot be claimed except 80 JJAA and 80M, nothing can be claimed. Additional depreciation. Brought forward unabsorbed depreciation due to additional depreciation. Current year scientific research expenditure, not allowed, which I have claimed. Here is the amount. Contribution to research 1 lakh. This will not be allowed. You will have a doubt whether I should add that additional depreciation, unabsorbed item, to the opening WDV. No, unless they say that it is the balance 10% of last year, etc. Don't do that. That is unabsorbed depreciation due to additional depreciation. We don't know whether 20% has been charged, 10% has been charged. So don't assume anything. Sorry. Yeah, only due to the, but unless they give you that it is only 10% charged last year, the balance 10% you cannot. This might be the entire 20% has been charged, and because of, they should specifically tell you the balance 10% or the asset value of the last year purchased during. Unless they given that, you don't add it up to the opening WDV. So total income as per normal tax return, I get 3166. I mean optional tax return 3166,250. First on STCG of rupees, how much? 3 lakhs at 15%. Same 45,000 both the cases. on the balance at 25% in case of normal tax regime. What is the total income under normal tax regime? 23, 28, 250 minus 3 lakhs into 25%. Repeating, this minus 3 lakhs into 25%. There are no other special rates taxation. On the balance at 22% in case of optional tax regime. This minus 3 lakhs into 22%. Straight away you can decide that normal is better. In the base level itself, because there is going to be surcharge, there is going to be HEC. Okay, so add HEC alone at 4% only for normal. Yes, 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 on the tax, not just on business, on tax. Surcharge is always computed on tax. Tax, all base tax should be. It will be very high. Already it's. Am I clear to you? Okay. We will do 115 BAC at that time also. We will come back to the same provisions and read. There also for individuals the same provision. We will do more of optional tax regime, but optional tax regime can become a question. Definitely going forward it will become a question, or they'll ask you to compute. Always compute total income, from there make the adjustment for optional tax regime. You will be much better position. Okay, right? So this is optional tax regime. Next class, that is tomorrow morning, we are starting with assessment of companies, completely PGBP oriented. Okay, whatever we have studied we are going to recollect and do it. Meet you tomorrow morning for assessment of companies. All the best, guys.